We are going to follow up on such an interesting conversation, getting through the future of markets. And by markets, in this conversation, we're going to deal with financial markets, labor markets, market infrastructure, and even money, with the best in the business and people who are on the front lines of dealing with these questions every day. Lucas, Dante, Bouchra, and Karen, why don't you give your name, rank, serial number for everyone, and then we can jump right into it.
Want me to start?
Yeah, go for it.
All right, well, thanks for having me. Lucas Moskowitz. I'm the General Counsel of Robinhood. I've been there for about 5 years. Before that, I was in and out of government and spent many years at the SEC, including as the agency's Chief of Staff under Chairman Jay Clayton.
Dante?
All right. Hello, everyone. I'm Dante Disparte. I'm the Chief Strategy Officer and Head of Global Policy at Circle. The one-liner is I've been uploading the US dollar onto the internet for some years now.
Excellent.
Good morning, everyone. My name is Bouchra Darwazah. I'm a Managing Director at Galaxy Digital, where I run principal trading and investment strategies. In a nutshell, think about optimizing for the company's balance sheet.
Karen.
Hello, last but not least, I hope. I'm Karen Kimbrough, Chief Economist at LinkedIn. I get to look at over 1 billion members worldwide, what jobs they have, what employers are looking for, and it's honestly one of the best jobs on the planet.
Well, you certainly have some data that I think everybody in the world really wants to know and get a hold of, particularly at this moment. But Lucas, I want to start with you. We had heard from Brad Garlinghouse about the Genslerian era. You know, one of the questions that I'd asked him, and it was, I think he thought it was an interesting question, was whether or not he felt that retail investors were a positive thing in markets, particularly given this kind of division and tension between sort of the institutional side and the retail side. How have you seen, from your vantage point over at Robinhood, how have you seen retail markets evolve? And maybe I can also ask you the same question about retail investors. What exactly should be their place in financial markets and investing and even price discovery?
It's a spicy first question.
Yeah, I know. I love this crowd. No one's shy. So this is going to be a good group.
I think we've seen a revolution in retail investing over the last 5-6 years, and I think it's unequivocally a good thing. It's unequivocally a good thing for the investors themselves, for the markets, capital markets in the US, and for our economy, right? You think about it, we have 67-ish%, I think, US households invested in the stock market. Nobody else in the world has anything close to that. It's one of the reasons why our markets are the best in the world, and everyone wants to emulate us. And then you look at the benefits for the retail investor, right? Robinhood alone has close to 26 million, I think around 26 million retail investors who have funded an account, right? So those folks are all in the market. They're doing various things, but largely they're investing in, publicly traded securities, and some obviously do crypto and other products. But what's going to happen here, and you've seen, in the initial kind of explosion of Robinhood and others onto the scene, several years ago, and the influx of retail coming into the market, is you had a much younger customer base, more diverse than the incumbent firms. About half of our investors are first-time investors, and you saw obviously a ton of activity in 2020 and 2021 and beyond, and I think there was a reaction to that, and that reaction was twofold. The first was, okay, this isn't going to last, right? Well, that's wrong. It's lasted, and I'll talk about that more in a second. And the other reaction was it scared people. It scared people in Washington. It scared people in the industry, and there was a backlash from regulators on that. But the reality is that these people are staying in the market. Most of them we see exhibit buy and hold behavior. They're not doing wild things on our platform or other platforms. And if they stay in the market long term, which we think and hope they will, and we're obviously building our products to match that desire and that need for these customers, then they're going to do quite well. The U.S. stock market is probably history's greatest source of wealth creation, and so that's a very good thing for everyone. I read an article in the Journal a couple of days ago, and they had some anecdotes from some retail investors, and one gentleman said, I don't have to live paycheck to paycheck anymore because of the investing I've been able to do on these mobile-driven platforms, and that's an amazing thing. Of course, there are many stories out there, some maybe about customers losing money, but by and large, folks are taking advantage of this for the good.
You talked a little bit about those challenges, and so I want to go to Dante to even draw a couple of analogies. I don't think there's anyone actually who's more responsible for the Genius Act, getting it over the line and pushing that conversation forward and that legislation forward than you. When you think about that journey, on the one hand, where we have a conversation about the evolution of markets, from the retailization of markets or the re-retailization of markets, and now we have sort of a new rethinking of money and getting that a kind of legislative wrapper around to reflect that change. Like, what was that journey like? And do you see any analogies as well in what you see in other areas of fintech?
Yeah, I mean, first of all, it's a great question. It took me riding on the new Acela train to New York to come up with my new one-liner on money, which is you can't put new money on old rails. Because I'm not going to lie, the trip up to New York on the new Acela train betrayed the fact that the rails are still old. And so unsurprisingly, that trip felt bumpy, and the train actually broke down and needed to be rebooted twice. Which is in some ways a real analogy of the money system and the money movement system we have in the United States of America. So a fateful 7 years ago, a fateful little project called Libra, I was one of the protagonists of that project, and despite a history in the public domain debating against the sins of big tech, if you read anything I had written about it, I wasn't a fan nor a friend. But what I had to remind my friends and colleagues and family around the world is that I loved financial inclusion more than people hated Facebook. And that was what got me summoned to every single hearing ever since, and then finally culminates, of course, with the Genius Act, which is a very rare example. Twice in my career, I feel like I've united Washington, once in its hatred of that project, and then second, not alone, but obviously with the industry and many others, the second time, of course, in the desire to regulate payment stablecoins as the American answer to winning the digital currency space race. And so the other quote I would give, Chris, more germane to this panel, is you can't have the economy of the future unless you have the money of the future. And when you think about money as it stands today, unevolved, our entire financial system and our entire global economy has hit points of diminishing returns. It's not really your money if you have to ask someone to spend it, and you have to pay someone to hold it for you. And so the emergence of fully regulated, audited, transparent stablecoins allows us to conceive of things that wouldn't be possible. Robinhood is a great example, but I'm sure many others who will enjoy the stage here at DC FinTech Week can really start to see the unlock that this introduces. The payments environment is encumbered by walled gardens. Inside the walled garden, you get fast, cheap payments, but most of that is just the veneer of speed. What stablecoins have introduced is actual speed at scale around the planet. So USDC 7 years ago, 0. Today, close to over $76 billion in circulation. We processed, $42 trillion in cumulative activity over that same 7-year period. But the key is that we've done so where any basic internet-connected device is a compliant payment endpoint. That is a total breakthrough in payments. The piece that then relates to modernizing markets, and you saw a recent communique from the CFTC on this point, Secretary Bessent recently met with the Chancellor of the Exchequer, Rachel Reeves, and announced an initiative on modernizing markets between the United Kingdom and the US. Really important initiatives. But one of those, what the communique with the CFTC and Acting Commissioner Pham produces is this notion of being able to use this innovation, which has historically been payments, or relegated by some as merely a poker chip in a crypto casino, can now be used as collateral in capital markets. And therein, you could envision a financial system that doesn't take bank holidays. You could take advantage of the programmability and composability of fully reserved internet money as the basic foundational building block for money that works for you as opposed to you working for your money. Now, if that is wrong, I'm totally tech agnostic. If that is wrong, I don't want to be right. It is one way to look at it, because I think that innovation has to be uniquely stamped with the seal of American legal approval. And if we do that right, we win the digital currency space race. If we fail, we're not going to like what the world will look like a decade from today, when alternative payment systems and alternative currencies have filled that void.
So, Bouchra, welcome to DC FinTech Week. You're one of the, I don't want to say shadowy. I mean, that sounds so ominous. But you're one of those quiet people, leading trading over at Galaxy. But I think it's great to have you on this panel because, in a way, you're a consumer of these technology changes. That ultimately you use them, you see them, you embrace them. Maybe you laugh at some of them. I don't know. But maybe you can give us a sense from your experience, from your views from the trading floors as an institutional actor. How are you viewing the rising tide of technology infrastructure and also asset classes, and how is this impacting someone who's, I don't know, I think of you like with a joystick or something, day trading or something, but how does this impact your job?
Well, thanks for taking me out of the shadows today.
Thank you, you're welcome.
Glad to meet all of you today. I wanted to take you guys just a little bit take a step back. I started my career trading at Goldman Sachs in the rates derivatives desk, and that was right around the financial crisis. We've come a long way. You took us back to 7 years, Bitcoin white paper 2008, so pretty much around the same time. Our jobs were more manual, intuitive, like the trader job back in the day would be, I have an idea, I'll put that into a position, and your tools were pretty much your internal spreadsheets, your Bloomberg terminal, and if you're lucky, internal models. At the time, actually, we were lucky at Goldman, we had a centralized risk system that could actually show us the risk at a firm level, which helped us a lot during the financial crisis. Fast forward to today, my job remains the same, but the tools are completely different. Thanks to all of you here, working on all these things to improve our lives, and I would slap AI into it. I still wake up every day, very early, and I need to look at a macro story, and from that, analyze what could be a good trade to put on a risk position to have in our books. The way we do that now is much faster. We have better data. We have more tools, and AI on top of it is making our lives much easier. I'll just give you a specific example. In rates, we are optimizing for convexity, volatility to comply with Basel III. In foreign exchange markets, we can actually toggle across stream and venues to optimize for liquidity, especially in fragmented markets. In crypto, we're a market that trades 24/7, we have the ability to go over trade in venues, optimize for those, follow on-chain activity. Those things were not what we were doing in 2008, 2009, by no means. The regulatory landscape has changed dramatically as well. And our job as traders is no longer just the typical idea that you have that trader risk taker only. I would tend to call us now risk engineers. We have to optimize for capital requirements, collateral, and risk positions. So the trader or investor job is no longer just an intuitive, have a good judgment, experimented person. It's a rather risk engineer that complies with a lot of transparency rule that has to optimize for balance sheets and capital structures to actually be a good trader at the end of the day. Different jobs, same words, and our job couldn't be different since last 15 years.
Okay, great. And I'll ask you a little bit about your job and about jobs in general, because I have to ask, so how's the economy? Wouldn't mind a little bit of data about that, Karen. I'm sure you guys have your fingerprints and fingertips on all kinds of interesting sort of labor data. But I do want to ask sort of a two-sided question. Number one, how has your job transformed at all from technology changes? Just as an economist, much less an economist who's working on a technology platform, number one. And then, anything you can tell us about the economy, just in general.
All right. Well, I will say, I spent all summer looking at non-farm payrolls going, gosh, I don't see that hiring in our data. So the revisions made me feel better. I'm probably the only person who was like, oh, okay, yeah, it is as bad as what I saw at LinkedIn. We are definitely in a hiring recession. We're not in an economic recession, but we are in a hiring recession, and we've been in one for over a year. So yeah, the labor market's stable if you have a job, but it's very fragile. It's precarious. If you don't have a job, it's tough to break into. That's the headline for the economy. So what I would say is, and this maybe gets back to what Bouchra was saying, what we're seeing is that roles are changing really rapidly. We think that 8 to 9 out of 10 jobs on our platform, and there are millions of jobs on our platform, are going to be radically different by 2030. And it's not that the title necessarily will change, although there are new titles coming on, new roles, but mostly it's the kind of tools you use and the skills you need to have. So an example on my team is I have a bunch of computer scientists, economists, data scientists, and what used to take maybe 1 to 2 weeks of coding, checking the code, running it, seeing it, now takes 3 hours. So we spend more time on idea generation. We spend more time thinking about, well, what could we say with our data about whatever, whether it's new entrants and how they're doing, older workers, or a particular industry, and less time actually rewriting the code or working on the code. We just check it, and then we keep moving. We have AI working on it for us. So my job's already changing, which means I have to upskill. And I'll just tell you one fun fact that we see in our data. So every year we make a list of what are the top fastest growing new tech skills, and 2 years ago it was LLMs. 2 years ago it was all AI. Before then it was oh, you need to know whatever Python and Spark and whatever, Scala, Java, blah, blah, blah. And then about 2-3 years ago it became all AI skills that were the fastest growing skills. So large language models and of that sort. Now, this year, it's all AI agents. It's personalized GPTs. It's just evolving. The skills are evolving really rapidly. So the job titles are often the same, but the skills underlying these jobs are different. And what I'll leave you with—
Are these the requirements, or are these the people who are applying for the job?
Both. So if we're talking about the financial industry, that's one of the industries that's, I'll say, upskilling the most, where people who realize they want to keep and hold their job are rapidly changing the skills they have through learning, through courses, through different skills on their profile. So the finance industry is at the tip of the spear with the tech industry in terms of acquiring these AI skills. But in terms of what jobs are out there, there are 3 times the growth in jobs for AI. How do I put this in an easy way? If the growth in AI jobs is growing 3 times as fast as any other job. So if it's a job that requires AI skills or AI literacy, those jobs are growing 3 times as fast in terms of what employers are looking for. Employers want AI skilled or AI literate talent. They know they can't hire it fast enough, and it's super expensive because that talent is a micro fraction of the population. So they know they need to look for those skills or upskill their own people. And I'll stop there.
So what I'm hearing is employers, private market participants, particularly in financial markets, want to have people who have those skills. It seems that there are 2 interpretations of that as you think about a company like Robinhood. On the one hand, you may want people who have those skills to be able to use new technology and emerging technology. It could also be that you want those people to be able to build new technology in its own right. 2-part question. I'm a law professor. That's what we do. Number 1, from Robinhood's perspective, from your perch, do you see one more than the other? And then number 2, what should the regulators be doing in terms of their sort of technology stack?
Yeah, we're in this period of massive innovation, AI being the most salient, but there are lots of other things going on. Mm-hmm. It's not just AI. It's a little bit of chicken egg, who is driving this type of innovation, right? Is it the customer saying, hey, we want this product or this service, or is it the firm saying, look, how do we use AI to provide a new experience to customers that they've never seen before? And the reality is it's both, right? I mean, I talked a little bit about our customer base, right? It's younger, it's very tech savvy. These folks want easy access to the markets. They want it to be very cheap, and they want it to be new, and they want to have variety in that, right? So, we started as a traditional brokerage, right? We put stock trading and investing on an app and brought the fees in terms of commissions and account minimums down to 0, right? But now you fast forward 5 years, you can go on Robinhood and do prediction markets. And prediction markets are one of our fastest growing business. You can trade the Fed funds rate. You can trade, an entertainment event. You can trade other economic events. You can right now trade sports, and that's a big thing that's going on in state versus federal right now. So the reality is the customers, I think, by and large, are generally demanding, more AI, more products and services that are new and innovative and take advantage of technology. But we're also hiring, trying to get the best talent in terms of AI and in other areas to make sure we can think ahead, right? I mean, I don't know if customers really were saying, hey, I would love prediction markets, right?
But what does that mean, like, in reality? Because even if you introduce, like, one thing that Dante's obviously seen over his career, something that you see consistently, if the velocity of the introduction of the new product is at a pace that the regulators either A, don't understand, or B, don't even have the infrastructure to be able to accommodate, there's like a disconnect. So even as you're moving forward, and even if you get the demand from customers, and even if you get more opportunities for portfolio diversification and the like how do you, what should the regulator, what kinds of expectations would you have of regulators in terms of their ability to accommodate the velocity of technological innovation?
Yeah, I mean, look, there has to be a balance, right? We didn't strike the right balance under the Biden administration. We had a massive backlash, and again, we were innovating. Other firms were innovating. Crypto was obviously growing, and the response to that was we got to tamp this down, right? And we got rules like the predictive data analytics rule out of the SEC.
Yeah, that was
anybody
the one-pager?
followed that? Yeah,
that was pretty.
It was the dumbest rule I've ever read that has ever come out of the federal government, and I've been doing this for a long time, and having sat in that seat, it was the worst. It would have basically eliminated the use of technology when interacting with your customer, unless you want to be a fiduciary in every single communication you make, which is unrealistic. So that was just the worst reaction. Now, of course, it's shifted. And we want it to shift in a responsible way, right? We need regulators to to be able to understand this, and that's incumbent on the industry. You can't expect regulators that have been around since the 30s or even earlier to fully be able to understand everything that's happening at this rapid pace. And so education's part of it. They're obviously trying to get talent in to understand this. But the other part of it is that striking that balance. And you gotta be able to allow firms to innovate. The rules are flexible, and there will be adjustments that need to be made. That said, you don't have to get rid of the entire rule book.
So, okay, or create new ones. Dante, that's where you come in, right? I mean, you literally have been there on the front lines. You're still, Circle is, every single time I check, even though I sometimes avoid crypto Twitter, there's always something new coming out on LinkedIn, Twitter, social media, some kind of new product. I mean, what kind of regulatory stack works to accommodate that velocity of innovation?
Well, for one, the Genius Act, going back to it again, is important because it reconciles what in our country is unique. The United States is unique in all of the advanced economies in not having a national payment systems charter. And so payments companies like us and all of our peers, Visa, Apple Pay, PayPal, the lot of them, are regulated at the state level. But the challenge and the competitiveness gap is that when you're competing at the type of scale that we're competing, where you literally have nation-state actors trying to modernize their payment systems to get away from the long arm of the US dollar or the long arm of the American banking system, then you do need the imprimatur of federal rules, which we now have with the Genius Act. So the Genius Act has reconciled that fintech constitutional crisis and fintech federalism question. But in an ideal world, it would also do so in a technology-neutral way. If there's one broad policy failure I think the entire world has labored under when it comes to blockchain and fintech and every other novel technology, is that we have failed the technology neutrality test. Regulators do a good thing of speaking of activity-based, risk-adjusted rules, but on tech neutrality, we have woefully failed. And if you look to today, and you look at the categories that have succeeded very well, I think there's two really big, interesting technologies right now. It's AI and stablecoins. But not all stablecoins are created equal, and what we clearly need is a category of stablecoins, either under the Genius Act or frameworks around the world, that would pass the very basic Jerry Maguire test, show me the money. And you no longer have to rely on someone's Twitter account for promissory statements of whether or not this was a product that is redeemable and plugged into the banking system. I think that's exactly what we now have in front of us. And that ought to create, in my view, much more accessible, much more novel forms of money and money movement that will effectively allow people to do more with less. I mean, that's the trade-off. I think implied in a lot of the data, implied in the conversations, is that to make money presumes you have money in the first place in our capital markets. And so we now have a pathway in which we could make a broader form of economic inclusion, economic participation. But the bottom rung of that ladder of economic mobility is payments.
Yeah, it was interesting. We had Travis Hill earlier, and I said, I told him, when you look at some of the issues he's thinking about, de novo banking licenses, when you think about just getting more banking institutions available, and then you go to the SEC and you're looking at the drop-off of IPOs and trying to figure out how do you increase IPOs and capital access. That financial inclusion to capital access question, there's a little bit of a spectrum. It seems like all of the different agencies are grappling with that. Bouchra, okay, so you are an institutional trading maestro. You're listening to some of the other colleagues, to your colleagues here on this panel. We're talking about blockchain, crypto, new trading platforms. We're talking about AI. Okay, so which one's going to be the most important for your role, but also risk management? And I want to preface this by saying I was shocked when I was listening to Larry Fink yesterday on CNBC. He talked for about a half hour, and I would have thought that the vast majority of his conversation would have been about Gen AI, actually. I would have assumed it. But instead, the bulk of his conversation was about tokenization of stocks, tokenization of real world assets, crypto, stablecoins, and the like. There's a whole panoply of different sort of innovations. What's going to impact your job the most, you think, a couple of years from now?
Well, first, thank you guys for all the work you've been doing. Because this is probably the first time, and to double click on Larry Fink's point, this is the first time actually we're seeing a real convergence of blockchain, AI, and market infrastructure. This is the first time. Just start with the blockchain side, and to clarify that a little bit more, to why actually, one of the biggest institution asset manager in the world is, double clicking on tokenization. Tokenizing assets would change the way we settle and fund trades. In the most liquid market in the world, that's a huge transformation. Imagine being able to post treasuries, tokenized treasuries, 24/7 on basically trades margining on the margining side. You changed completely the repo and the whole derivatives margining story. And those are the biggest, most liquid markets in the world. So Larry Fink has a reason why he's, been a big proponent of the tokenization story. And what that means for institutional traders, you have much less friction, much shorter settlement, and all of a sudden you have this pool of collateral that's fungible, ubiquitous, and global. And here you go. You globalized basically your equity and rates and FX market basically to that extent. Derivatives markets are much bigger than the actual underlyings themselves. And this is a huge change in the way we do basically our job. So that is one of the biggest innovations. If done, blockchain technology will be a huge changer in finance. Add in AI to it. Today, actually, AI models can go over basically balance sheets. They can read central bank tones. They can do basically a lot of things that we're doing. So, and then you bring the question, so you become an obsolete as a trader? Absolutely not, because our job today now has changed. I have to be a system designer where I'm giving input, I'm putting guardrails and knowing when I intervene as a human and teaching basically these, with all my experience, these new AI models that are coming in to help us basically augment our job. I'm sure a lot of you guys have heard of the 10x engineers. I would call it the 10x traders, not P&L-wise, because it's pretty hard. Markets tend to be a little bit more efficient. You just need to be right 51% of the time to make money in our job. However, this is a very big game changer. So you're changing the market infrastructure itself by adding the tokenized, story. You have much better tools where you're no longer just a risk taker. You are building the networks yourself. And the third part, crypto trades 24/7. So a lot of people in my family actually sometimes make fun of me. My sleep schedule tends to be very interesting, with trade in traditional markets on one side, where you have the words open and close, and crypto that trades 24/7, and people, so at some point, we're gonna have a convergence of the two. We already have futures that are trading pre and post markets in the traditional markets, but I know that exchanges are basically exploring how they can move to that 24/7 cadence, and all of a sudden, we won't talk about crypto and traditional finance anymore. We will just talk about one global market that's sitting on one network, where our jobs here, or my job, I guess, here on this panel, becomes a systems engineer that needs to be able to have its judgment and market view, et cetera. That's fine, I'm a risk taker, but I'm also a participant in building this network of liquidity that's becoming much more global.
So there's a breakout session going on right now on fraud prevention and with the Financial Technology Association, and they're talking a little bit about what Elise had brought up earlier. But when you think about, and they're talking about the upskilling of different jobs also on the financial regulatory side and innovation there. What I find really interesting though about what you're saying, and I had mentioned earlier that I've been traveling a lot, and whether or not it be in the Middle East, whether or not it be in South America, there's this same question of saying, look, the United States has made a choice to start to change its pipes. And your question is, do you want your pipes to be interoperable with the pipes in the United States? 20 seconds, because I still have a question for Karen. Do you think you're going to really get to interoperability? Does it require the entire world to make that shift, or is it just enough if it comes out of our capital market due to our size and liquidity?
Exchanges, the biggest exchanges are looking into it, and the banks are starting to look into it as well. And you either jump on the bandwagon or you're left behind. I don't think the market is giving us a choice. People have to jump on the bandwagon as long as we are within the regulations that we have in front of us. Having the rails on the back of it and working on them is inevitable at this point.
When a trader says jump on the bandwagon, no, I'm sorry, it's like this. Okay, trading joke. Okay, Karen. Okay, we only have a minute left, but when you look at, and you've heard all these different kinds of ideas and questions of digital transformation, what does that mean? And I don't know if you can provide any kind of granularity. I mean, does crypto pop up on your radar screen in terms of, and has there been crypto's dead, oh, crypto's here, crypto's great, it's okay, now it's on-chain. I mean, what does the labor market look like for on-chain finance? Do you see anything tracking what Bouchra is saying?
So this is the question I get from everybody. It's okay, what are the hot jobs, including for my kids? What should I study? Look, let me say two things. One is, last year, we looked at all the people just in the United States who took a job. So not everybody on our platform, which is 220 million people, but just the ones who changed jobs. Of those people in the United States who changed jobs last year, 20% of them took a role that did not exist in the year 2000. It was just a title that just really did not exist. It was minuscule. So that's 25-year look back, already massive change. What are we seeing right now? Well, in finance, I would say more disruption in the risk space, trading, compliance, a lot of disruption in insurance. But if you're a financial engineer, a trader, there's still appetite for you. She'll always have a job, it's clear, it's too smart to not. But in crypto, yeah, one of the fastest growing skills. And I'll just say this, I'll leave you with one other fact. Right now, we're seeing this enormously rapid rise in people trying to gain AI literacy, the ability to use AI tools in whatever job they have, because they know if not, they're at risk of being obsolete.
Yeah, well, we are about to transition into a demo and a kind of a TED Talk 101 plus demonstration on AI and agentic financial services with Mickey Iqbal. But before we do, I want to thank this panel. Having this breadth of experience on all of these different aspects of financial markets is great, so thank you very much, and we'll get to our demo.